Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is Fed funds rate. In the US, the federal funds rate is the interest rate at which depository institutions actively trade balances held at the Federal Reserve, called federal funds, with each other, usually overnight on an uncollateralized basis. The current Fed funds rate is effectively zero. To combat the financial crisis of 2008, former Federal Reserve Chairman Bernanke lowered to this level by aggressively dropping it 10 times in 14 months. Obviously, this is the lowest the Fed funds rate can go. The highest was 20% in 1979 when former Fed Chair Paul Volcker used it as a tool to combat inflation. For more on the Fed funds rate highs and lows, see historical Fed funds rate. The Fed uses the Fed funds rate as a tool to control US economic growth. That makes it the most important interest rate in the world. Banks use the Fed funds rate to base all other short-term interest rates. That includes LIBOR, which is the interest rate that the banks charge each other for 1 month, 3 month, 6 month and 1 year loans, and the prime rate, which is the rate banks charge their best customers. That's how it also affects interest rates paid on deposits, bank loans, credit cards and adjustable rate mortgages. Longer-term interest rates are indirectly influenced. Usually, investors want a higher rate for a longer-term Treasury note. The yields on Treasury notes drive long-term conventional mortgage interest rates.